And I want to focus in on first the U.S. And what's going on here. Mike just talking about the Fed. A lot has been made about these three dissenters. Do you think it makes a difference that he had three dissenters, or do you think if things really get bad, they will change their minds?
You know, the Fed's facing a lot of pressure. Some people believing they've done things like generated some of the inflationary aspects in commodity prices. So there tends to be that kind of tension going on. But ultimately, the Fed will come in and support the market if they have to.
Is that what you read into the statement yesterday? I mean, initially there was disappointment down here, and then we shot up like nobody's business, although we've lost most of that today.
I don't think a lot of people understand what happened the last hour and a half or so of the market in general, so I think that it's confused a lot of people. We haven't seen a lot of major trading. If you look at the Bloomberg ticker and you go to your terminal, you just put in a ticker, put in equity, AQR, look at where the volume is, you'll see one or two big trades and then a lot of really small trades. So it's confused a lot of traders in the marketplace.
Tobias, it's Betty here in the studio. What would make you take down your estimates?
It's a good question. I've been receiving that question a whole bunch in terms of estimates. I think it's a real issue in economic growth, and I think everybody has estimates on the street are starting to come down. So our analysts are cutting areas like multi-industry, electrical equipment, chemicals, anything really cyclical, you're starting to see that coming down. But more importantly, for the target on the market, it would be the credit problems kind of moving from Europe and starting to infect the entire banking system.
We should point out you have a 1,400 estimate target for the S&P. That's about 20% and change from here. I mean, does that rally seem doable to you this year?
It's certainly doable. The average bear market rally is over 40%. So if we're saying we get half of that once we stabilize and we lower earnings estimates to a level that's much more reasonable, markets aren't as affected by the earnings number, but where are they relative to the estimates?
But you say bear market rally. Are we in a bear market here?
Well, we've been saying bear market since 2001.
Since 2001. So along with Gary Schilling, although you're more positive for this year, you think also $98, talking earnings now. Do you still think that target is doable this year?
I think it's doable. Could we lose $1 or $2 over the course of the year? Possibly. Remember, more than half of that's already in the earnings in the first half. So could you have to trim a little bit? Certainly plausible. But I think the critical issue is what's going on with credit in Europe, and does that kind of dismantle some of the stability and the low cost of capital the business has been benefiting from, and therefore they can invest against those costs of capital. And that's kind of what happened in 07, 08. We saw subprime eventually leach into the corporate credit markets, and the question now is, does some of the European sovereign factors start to leach in? And at the margin, we're seeing somewhat higher cost of capital.
Tobias, why is it? I mean, because for so long, right, throughout this last year and a half, we've been talking about Europe not affecting the United States. What's the difference now? What is different this time around?
I
think initially, if you kind of sat and looked at countries like Portugal, Italy, Ireland, Iceland, Greece, and added it all up, their debt as a percent of total debt in Europe was about 2%. Throw in Spain, that's about another 6%, 18% if you've got Italy, and France is even bigger. So you put those together, and that's the instability. Most banks in Europe's bank capital is tied up owning sovereign debt. And if you have to start marking down that sovereign debt, does people wonder about the bank capital, and does that, again, spread into counterparty risk?
Matt, I know you got Tobias down on the floor of the New York. Maybe he can shed some light, connect the dots for us on the problem with the European banks and how that affects the U.S. banks.
Yeah, Adam, I think, a lot of people wake up and see this news about Europe and don't understand why it translates so quickly into huge drops here. I mean, I can understand that maybe French banks hold a lot of French debt, so if there's concern about a French downgrade, you could understand why they take those banks down. But why do we see the bank sector here, for example, leading us down?
Well, I think part of it is the counterparty risk. We do trades with a lot of these institutions in Europe, with the banks in the U.S. But more than that, you've got loan activity going on in corporates. So if the credit environment starts to deteriorate, what you tend to see is economic conditions deteriorate, and people start worrying about how good are those loans and things like that. When you have large global banks in the United States providing, those loans to people all over the world.
So the counterparty risk, also business just slows down as, I guess, U.S. banks try and at least reduce their exposure a little bit, right?
I think that's true. I'm going to give you one other thing, which is when you look at the bond yield here coming in, what you're seeing is you borrow money cheap from the Fed, you theoretically can put it into a treasury, but that yield, that kind of curve of the yield has flattened out, and there's less margin in there for the banks. So that's something very domestic. It has nothing to do with Europe.
Tobias, I want to get back to the overall market because as you're talking, I'm watching the Dow now. Ever and ever, it is losing more points. It is now off by 400 points. It almost looks as if we were going to basically wipe out all the gains that we had yesterday. So if we basically end up flat from the last 48 hours, what does that tell you?
It just tells me a lot of investors are incredibly nervous. There's great uncertainty on the economic outlook and as a result, the earnings outlook. And I keep going back to this issue about European banks and lending activity and the cost of capital. These are issues that really reverberate. Keep in mind the U.S., and I keep pointing this out to people, the U.S. and Europe account for nearly 50% of global GDP. It's nice to talk about China, but that's 7.4% of GDP globally. So if something happens to Europe and the U.S. economic conditions, that really impacts overall expectations. And I think that's the thing that keeps bothering investors in the back of their minds.
Hey, Tobias, it's Adam. Where should investors be more concerned, European banks or U.S. banks? And can you possibly buy either one of them or both of them at this point?
I'm not an expert on Europe, so I really don't want to tell you that much about what you should buy or not buy in terms of those stocks. But I think the view is that U.S. banks are better capitalized now after we went through TARP. And Europe doesn't have that kind of structure. So I think there's the greater concern is clearly there. Could there be nationalizations? Who knows? But those are the kinds of things. If there are, then equity gets wiped out.
How about which are the most important balls that investors have to keep their eyes on here? Because you've got the problems in Europe, right, which we're focused on today. Yesterday we were focused on the U.S. Fed. Over the weekend, Adam in particular, focused on the downgrade of U.S. debt. I mean, the U.S. economy. What's your main concern here? What's the biggest risk that you're watching closely?
Well, I'm going to answer it in two different ways. I think the downgrade of the U.S. debt, and this isn't, I'm Canadian, so I don't have any patriotic duty to defend the U.S. I don't think that was as big a deal as everybody thought. The timing was shocking, but not necessarily the outcome, because I think S&P had pretty much, indicated that through some of their prior announcement that they were headed in that direction. But and in fact, if you look at other conditions, you'll see that bond yields typically go down initially. I think longer term there could be a cost to this. The bigger issue, or the things I'd watch in terms of risk tolerance, gold, Swiss franc, the credit spreads, those are the things I'm watching most carefully to determine if something more dastardly is out there.
Also, Teddy Weisberg joining us from Seaport Securities. He's been trading down here for 43 years, and the volatility that we've seen the last couple days has been amazing. I'm not sure if it thrills you as much as the volume, I would think, would be good for you.
Well, I think the volatility must be thrilling somebody, but I think it's unnerving most investors, certainly long-term investors. The volatility is breathtaking. We've seen it before. It's not something new. This is more a byproduct of the way stocks trade today. I don't think it has a lot to do with the fact that markets going down. Markets always go up and always go down. But I would say the volatility just takes your breath away, and I don't know how anybody can quite figure it out at the moment.
Well, how long do you think it's here for? Because, I mean, Sunday going into Monday, I almost had a heart attack. Yesterday, I felt so much better after we came up. And today, when someone said we're down 400 points, I thought, I'm getting used to this now.
Well, and that's the problem. We're all getting used to it. But the fact is that it's very unnerving, I think, certainly for long-term investors. I mean, there are reasons for it, in my opinion. It's high-frequency trading. It's computer-driven trading. It's the absence of a short sale rule. There's a lot of reasons. But the bottom line is the volatility is here to stay, up or down, and we're just going to have to learn to live with it.
Let me ask you about this, Tobias, because I'm sure that day-to-day volatility doesn't make as much a difference to you if you're looking at the longer term, but we hear traders down here talk about high-frequency networks. We hear traders talk about reinstating the uptick rule. Everybody pretty much is in agreement that that would make things better. It would improve transparency. What do you think about that? I mean, why don't regulators jump to do something?
I think it's really hard to decide to put back the uptick rule. Things like dark pool investing, things like that electronic trading start to make it much more difficult to regulate. And often regulators are behind kind of the technological curve, and that's not new. That's been happening for decades. I think Teddy's probably seen this for a longer time than I have. Not that much longer.
1 or 2 decades, maybe.
Well, maybe 1 decade.
A couple anyway.
But in the sense that it's really hard to actually impose it, watch it, monitor it, regulate it. The technology has moved too quickly. So there are other ways you can do it, and you've seen it in some countries where they just said you can't short. I'm not sure that really gets capital into those countries. Ultimately, the capital will look for other opportunities.
Well, surely you don't want to ban short selling.
No, it's not about short selling. It's the tick rule is critical because it tends to dampen the volatility. And, you know, Tobias, I don't want to disagree with you, but it's not about dark pools, and it's not about high-frequency traders. I mean, that is a very narrow segment of the market. It might drive a lot of volume because they take advantage of the change in rules, but it should be about the investors, both the 100 million investors in this country and the investors around the world. I mean, these were historically the most transparent and the deepest securities markets the world has ever known. And quite frankly, the rule changes have sort of blown them up.
I don't disagree with you in the sense that there has been. I think it's difficult to step back at this point. But in fact, correlated trades around the world. So I'm not sure it's made us that much less interested to trade in versus other parts around the world. But I do think one of the issues that we have to recognize that 80% of the owners of stocks are institutions now, and they're the ones who are trading. They're owning on behalf of other people.
I'm sorry, we have to go to break.